Is this the real deal? Or just another flash in the pan? Chinese tech stocks are on fire, fueled by the hype around DeepSeek's AI models. But can this rally actually last, given China's economic struggles and regulatory hurdles? Goldman Sachs is saying this time, it might just be different. But what do they know that we don't? Let's dive in and uncover the truth behind this AI-powered surge. Get ready, because what we're about to reveal could change your entire investment strategy. Okay, let's break it down. Recently, Chinese tech stocks have been experiencing a significant upswing. This surge is largely attributed to the excitement surrounding DeepSeek, a Chinese AI startup. DeepSeek's AI models are seen as both globally competitive and cost-effective, which has really captured the market's attention. We saw a Tencent stock jump after they integrated DeepSeek's AI into their Weixin super app. Before that, Alibaba and Baidu also posted big gains. The Hang Seng Tech Index is up about 25% this year, showing just how strong this rally has been. But the big question remains, is this sustainable? DeepSeek's R1 model is the real game changer here. It's not just another AI. It's considered globally competitive and, crucially, cost-effective. Think about it. You're getting top-tier AI performance without breaking the bank. This is a massive advantage for Chinese tech companies. Now, let's talk about what makes this model so effective. We're talking about advancements in areas like transformer architecture, specifically optimized for large-scale language modeling, and the use of reinforcement learning from human feedback, RLHF, to fine-tune the model's responses. DeepSeek also employs knowledge distillation techniques to compress the model, making it more efficient and deployable on a wider range of hardware. According to the paper Scaling Laws for Neural Language Models, Kaplan et al., 2020, larger models generally perform better, but DeepSeek seems to have found a sweet spot between size and efficiency. It's a technical marvel and a strategic advantage for China's tech sector. Goldman Sachs believes this rally is different from previous ones. Their analysts argue that DeepSeek's AI breakthroughs are driving real changes in valuations and earnings. Unlike previous rallies that were mostly driven by policy news, this one is more about innovation and actual technological advancement. This is what they call micro and innovation-driven. They think this could give the recovery more staying power. They're not just seeing a short-term boost, they're seeing a fundamental shift in the landscape. And that's a huge deal for investors. So, how exactly will AI boost earnings? Goldman Sachs points to three main areas: productivity gains, cost savings, and new revenue opportunities. Imagine automating repetitive tasks, optimizing resource allocation, and creating entirely new products and services powered by AI. This is the potential that DeepSeek unlocks. They also estimate that a confidence boost could raise the fair value of Chinese shares by 15% to 20%. This is not just about short-term gains. It's about long-term value creation. They even predict that this technology may attract $200 billion of net buying for Chinese stocks. That's a massive influx of capital that could reshape the market. Let's look at Alibaba and Baidu. These companies were among the first to see significant gains. Alibaba's AI initiatives are focused on improving e-commerce experiences and optimizing logistics. Baidu, on the other hand, is leveraging AI to enhance its search engine and develop autonomous driving technology. These are just two examples of how Chinese tech giants are using AI to drive growth. Remember, these companies were hit hard by Beijing's crackdown on big tech in recent years. But now, they're bouncing back stronger than ever, thanks to AI. It's a remarkable turnaround story. Tencent's integration of DeepSeek's AI into Weixin is a game changer. Weixin is not just a messaging app, it's a super app with a massive user base. By integrating AI, Tencent can offer personalized services, enhance user engagement, and create new revenue streams. The stock jumped nearly 8% after the announcement, reaching its highest level since 2021. This shows the market's confidence in Tencent's AI strategy. Think about it. AI-powered customer service, personalized content recommendations, and even AI-driven games. The possibilities are endless. This is a clear example of how AI can transform a company and drive significant stock gains. Okay, let's pump the brakes for a second. It's not all sunshine and rainbows. Data privacy is a huge concern. With AI models becoming more powerful, the risk of data breaches and misuse increases. China's data privacy regulations are still evolving, and there's a lot of uncertainty about how these regulations will be enforced. This is a risk that investors need to be aware of. Think about the vast amounts of data that Weixin collects. Now imagine that data being used in ways that violate privacy. It's a scary thought, and it's something that regulators are closely watching. Then there's the issue of industry regulation. Beijing has a history of cracking down on big tech, and there's always the risk that they could do it again. The government could impose new regulations that restrict the development and deployment of AI. This is a major uncertainty that could derail the rally. Remember the crackdown on Ant Group? That sent shockwaves through the market. Investors are understandably worried about similar interventions in the future. The regulatory environment is a minefield, and companies need to navigate it carefully. The intensification of Western export controls is another challenge. The U.S. and other countries are restricting the export of advanced technology to China. This could limit China's access to the hardware and software needed to develop and deploy AI. This is a geopolitical risk that could have a significant impact on the Chinese tech sector. Think about the restrictions on semiconductors. Without access to advanced chips, Chinese companies will struggle to compete with their Western counterparts. This is a long-term challenge that China needs to address. And let's not forget about China's broader economy. The country is facing a number of challenges, including slowing growth, high debt levels, and a property crisis. These economic headwinds could undermine the AI-driven rally in tech stocks. If the economy falters, even the most innovative companies will struggle. Think about the impact of a recession on consumer spending. If people are worried about their jobs, they're less likely to buy new gadgets or subscribe to AI-powered services. The economy is the foundation upon which the tech sector is built, and right now, that foundation is shaky. Goldman Sachs emphasizes that forceful policy delivery, particularly fiscal stimulus, is necessary to soften the immediate tariff headwinds. China needs to boost domestic demand and overcome the disinflationary spiral. Without strong government support, the AI-driven rally could fizzle out. Think about the impact of tax cuts and infrastructure spending. These measures could stimulate the economy and create a more favorable environment for tech companies. But the government needs to act decisively and effectively. Now, let's play devil's advocate. Some analysts argue that the DeepSeek hype is overblown. They believe that the AI models are not as advanced as they're being made out to be, and that the rally is simply a case of market exuberance. They point to the fact that many Chinese tech companies are still heavily reliant on government support, and that their long-term prospects are uncertain. Who's right? Is Goldman Sachs too optimistic, or are the skeptics missing the bigger picture? The only way to know for sure is to track the actual performance of these companies over time. We need to see real revenue growth and sustainable profitability. Until then, it's all just speculation. To gauge the sustainability of this rally, we need to focus on verifiable metrics. Look at things like revenue growth, profit margins, and market share. Are Chinese tech companies actually generating more revenue and profits from their AI initiatives? Are they gaining market share in key sectors? We also need to monitor the regulatory environment and geopolitical risks. Are there any new regulations or trade restrictions that could negatively impact the sector? By tracking these metrics, we can get a more objective assessment of the situation. Don't just rely on hype and headlines. Do your own research and look at the numbers. So, what's the verdict? Is this DeepSeek-fueled rally in Chinese tech stocks a sustainable boom or just fleeting hype? The answer, as always, is complicated. There's no doubt that DeepSeek's AI models are a significant technological achievement and a potential game-changer for Chinese tech companies. Goldman Sachs makes a compelling case that this rally is different from previous ones, driven by innovation rather than just policy news. However, there are also significant risks to consider, including data privacy, industry regulation, export controls, and China's broader economy. Ultimately, the sustainability of this rally will depend on whether Chinese tech companies can successfully navigate these challenges and translate their AI investments into real revenue growth and profitability. Keep a close eye on those verifiable metrics and don't let the hype cloud your judgment. What do you think? Is this the start of a new era for Chinese tech, or will it all come crashing down? Let me know in the comments below, and don't forget to subscribe for more in-depth analysis of the tech world.